Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the best moving average strategies, focusing on four powerful indicators: the HMA, the ALMA, the EMA, and the SMA. These tools are essential for identifying trends. They're essential for identifying trends and we will break down each strategy to explore their strengths and weaknesses, ultimately help you determine which one might be more effective for your trading style. So by the end of this video, you would have a clear understanding of how to leverage on this moving average to potentially improve your trading results. So stay tuned as we unveil the complexity of these popular indicators and equip your valuable knowledge to enhance your forex trading toolkit. First of all, we start by understanding the whole moving average, which I'm adding to my screen right now. The whole moving average is a technical indicator designed to address one of the biggest in challenge in moving averages. It was developed by Hall in 2005 rather. The HMA combines weighted moving average and smoothing technique to create a faster and more responsive indicator. Unlike traditional moving average like the SMA or the EMA, which often lag behind price movement, the HMA provides a clearer and more immediate reflection of market trends. This makes it particularly useful for traders who want to react quickly to price changes. One of the key features of the HMA is its ability to reduce lag while maintaining smoothness. It achieves this by giving more weight to recent price movement or recent price data while still incorporating historical prices. As a result, it adapts quickly to the changes in market price direction, making it ideal for trend and potential entries and exit points. For example, when the HMA line is rising, it signals an uptrend. When the HMA line is rising, it signals an uptrend, as we can see. And when it's falling, it signals a downtrend. Notice how the HMA adjusts quickly to price movements compared to other moving averages. It is an excellent tool for trend following strategies. The HMA line is a red line which turns decisive than a corresponding simple moving average, that's the SMA, allowing you to spot trends earlier. However, like any indicator, the HMA has its limitation: its high sensitivity to price changes and can generate frequent signals, which may lead to false entries and choppy sideways market. Therefore, it works best in trending conditions. When you are to use this HMA is during trending conditions for with other indicators for confirmation. If we go to a sideways moving market, we can see that this particular indicator might not be that helpful in the sideways moving market. Like in this area in the market where the market was moving sideways, you can see how it's following price directly, giving us little to no chance to join this trade setup. In chart, you can see how the HMA performs well in a trending market. When it is trending to the downside, you see how it performs very well. But when you see how it performs in a choppy market, it is crucial to use the HMA in conjunction with other indicators for more reliable trading decisions, because this choppy condition is something you wouldn't want to trade in. The HMA, the whole moving average, is a powerful tool when used correctly. It is designed to solve problems of lagging in traditional moving averages while keeping the trend smooth. It's great for spotting trends quickly because it reacts faster to price changes However, be conscious in sideways moving markets because its sensitivity can lead to false signals. Now let's understand the next moving average, which is called the Orland Legoux Moving Average, which is the ALMX. This Arnaud Legoux Moving Average, the ALMS, is a unique technical indicator designed to provide smoother trends. This black line on my screen, it is designed to provide smoother trends and reduce lag compared to your traditional moving average like your SMA and your EMA. It is developed by the Arnaud Legoux and Dimitri in 2009. The ALMA uses the Gaussian distribution to assign weights to price data, filtering out noises and offering more accurate signals for trending markets, for both trend and reversal signals. This this makes it particularly useful in volatile markets where precision is key. One of the standout features of the ALMA is its ability to adapt to market conditions while maintaining responsiveness. By applying the moving average calculated from both directions, left to right and right to left, it eliminates common issues like phases shift and lag. For example, when the price stays above the LMA, when price stays above the LM ALMA, it indicates that we are in a bullish trend. But when price stays below the ALMA, it signifies that we are in a bearish momentum. Notice how the LMA line hugs price movement more closely than any moving average. This responsiveness allows traders to spot trends earlier while still filtering out minor fluctuations that could be misleading. Always remember that despite its advantage, the ALMA is not without challenges. Its complexity can be intimidated for beginner traders, and incorrect parameter settings may lead to misleading signals. To mitigate this, traders often pair the LMA with other indicators like the RSI or Fibonacci levels for confirmation. So when using this indicator, it will be good to use your Fibonacci retracement levels combined with this indicator for better entries in price. When implementing the LMA in your trading strategy, you might use it as a trend filter. It helps to combine with both short-term EMAs for entry signals. For instance, the ALMA is below the price and a 10-day EMA crosses above 5-day EMA. It signals a buy opportunity. When we combine this with our EMA and you see a crossover between the EMA and the SMA, it indicates buying opportunities. If it crosses over the LMA, it signals a buying opportunity. So it indicates a selling opportunity when the EMA crosses below the longer the LMA. The LMA crosses below the longer EMA. This is when it signals a selling opportunity, as you can see in this area, when the LMA is below this EMA line I just added. This is how to capitalize on the ALMA indicator. The next indicator we are going to talk about is the exponential moving average. The exponential moving average, which is the EMA, is a widely used technique indicator that places great weight on present price data, making it more responsive to current market conditions compared to compared to the simple moving average. Its responsiveness allows the EMA to adapt quickly to price changes, making it an excellent tool for identifying trends and time entries or exits in a trending market. Unlike the SMA, which gives equal importance to all data points, the EMA focuses on most recent price, offering traders a cleaner view of short-term momentum. One of the key advantage of the EMA is its ability to highlight areas of value in the trending market. For example, in an uptrend, a rising EMA can react as dynamic support areas in an uptrend, while in a downtrend, a falling EMA can serve as a resistance area. Traders often use popular periods such as the 20-day EMA and for the short-term trades, or the 50-day EMA for the long-term trade analysis. So if you want to use a short-term trade analysis, you can change this to your 20-day EMA. You can change this to your 20-day EMA to use them for short-term trading analysis. For the long term, you change it to your 50 EMA. Now that you have adjusted your EMA to be quick than the SMA during sudden price changes, this makes it particularly effective for spotting reversals or continuation patterns in trending markets. For example, for instance, when price pulls back near a rising EMA, as we can see, when price pulls back near a rising EMA, this signals potential buying opportunities. So we can buy from this support area because this EMA will act as a support area. However, like all moving average, the EMA is not perfect. In choppy or sideways markets, it may produce false signals due to its sensitivity, and it's to counter this, traders often combine with indicators such as the RSI or the MACD. Now let's understand the simple moving average. The simple moving average is a fundamental technical indicator that calculates the average price of an asset over a specific period. It's widely used by traders to identify trends and potential support and resistance level. So this is the SMA that I turned on my chart. The SMA smoothens out price fluctuation, providing a clearer view. For example, if we are using the 20 SMA, it's it adds up the close price of the last 20 days. This adds up the close price of the last 20 days and divides by the sum of the 20, giving equal to the weight each price point signifies. One of the key advantage of the SMA is its simplicity and reliability in trending markets. When prices are consistently above the SMA, it indicates buying pressure and it is in an uptrend. When prices are below the SMA, it signifies selling pressure and we are in a downtrend. Traders often use multiple SMA with different time period to confirm trends and identify potential entries and exit points. So we can combine the 20 EMA with the 50 EMA, which is a long-term moving average. Combining this helps us to get good entry points in the market. The popular strategy involves when the SMA cross over. This yellow line is our long-term 50-day moving average. The popular strategy involves when the SMA crosses over. When a short-term moving average, this blue line, crosses above the long-term moving average, like in this area, it signifies a buy trade and it's where you will look for your bullish signals. Conversely, when the SMA, the 20 SMA crosses below the 50 SMA, this signifies a downtrend and you look for bearish signals. Which of the best moving average strategy is the best? Which of the moving average strategy is the best? Each moving average we have discussed, the HMA, the ALMA, the EMA and the SMA, has its own strengths and weaknesses. So choosing the best moving average depends largely on your personal trading style, goals and market condition. So I would not be able to tell you the best. You have to study them bit by bit, practice them to know the best. When choosing the best moving average trading strategy, let's assume we are looking at the whole moving average, which is excellent for preferred fast signals and quick reaction. The HMA is better for fast moving signals. As we can see, it reduces lag significantly, making it ideal for short-term traders who want to enter and exit trades promptly. However, it is sensitive and can cause false signals in a sideways moving market. Now we look at the ALMA, the Arnaud Legoux Moving Average, which offers a balance between the responsiveness and the smoothing of price. The LMA is suited if you want smooth trend identification without sacrificing too much responsiveness. This is how the LMA is about. This is how it follows price and smoothing out little noise in the price. Now the EMA places more, let me put the EMA on my screen. Now the EMA places more efficiency or emphasis on recent price data, making it responsive to short-term moving changes. The EMA is ideal for traders who wants to focus on capturing short-term trends and momentum shifts. However, its responsiveness can lead to false signals too during period of consolidation. Now the next moving average we can look at is the simple moving average. And this simple moving average, on the other hand, provides stability and clarity by equally weighing all price data points within a calculated period. The SMA is best suited for traders who prefer a slow indicator that clearly identifies long-term trends. Its main drawback is its lagging nature and its signal, potentially delaying entries and exits. Considering all factors, the best overall moving average strategy for most traders is the ALMA. It strikes an effective balance between the smoothness and the responsiveness, making it versatile across different time frames or different market conditions. While the HMA and the EMA are great tools for short-term trading due to their speed, they carry high risks of false signals. The SMA is reliable but may be too slow to react to active trades. Ultimately, your choice should depend and align with your trading style. If you trade a short-term trade, you will have to prefer the HMA or the EMA. But if you are trading using the long-term option, you would have to use the SMA. But if you seek versatility and reliability across various market conditions, the ALMA stands out as the most balanced choice. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.